What's up, guys? Welcome back to the $500 Robinhood Challenge. Just a little update from last week. We had one option expire worthless last week, and that put us 20 bucks up. I'll show you guys that here in a second. But as you can see, we're down a little bit overall for the week because we have some options expiring next week, and these will fluctuate intraday. So you see this Twitter, call, AT&T, so American Airlines, and then we have the Bank of America. So anyway, today's video is all about what the heck is a credit spread. I know I probably confused the crap out of everybody in the first video, so we're going to try this again. And I'm going to try to give you just an example of a credit spread, and we will buy one here live on the video. So I can show you guys how to set it up. It's pretty much the same on mobile and desktop. You'll be able to figure it out pretty easily. So what is a credit spread? Now, I'm not going to use any fancy charts or profit loss diagrams and all that stuff because honestly it's confusing to me, and if it's confusing me, I'm sure it's confusing to you guys. But listen, we'll go to TradingView just for illustrative purposes. I don't do a lot of charting. It can help for sure if you're good at it and if you know how to read it, but let me tell you, two people can look at the same chart and you'll get two different answers. One will be like, oh, it's clearly a downtrend. The other will be like, oh, it's clearly due for a reversal. So like I said, use charting if you want. Don't use it. I just go by price action. I will look at some other things just to get a market sentiment, but anyway, let's move on from there. So I want to look at the Spider Series Trust, the retail ETF for Spider. One of our major advantages as options sellers, as net sellers, is volatility. We want to be selling when volatility is high because we get more premium for selling. And on the reverse, we want to be buying when volatility is low because we get a better price for the option that we want to buy. But I still think you should be net selling. You should be selling more often than you're buying. Buying is really literally gambling. Buying is literally gambling. I mean, it's all gambling, but buying is more like buying a lottery ticket versus making a bet on the money line, if anybody gets that reference out there. So what is a credit spread? Like I said, I don't do any charting, so I'm going to try to help you guys or with some visuals here. Okay, let's just say we want to put a bet on XRT here. And we're going to just pick a random, actually we might go ahead and pick the price we're going to use here. Let's look. So I don't care. Like, honestly, the direction it goes is important, obviously, but it's not so important. Okay, so like I said in the first video, there's 5 ways that this thing can go. It can go up a lot, it can go up a little, it can stay the same, it can go down a little, and it can go down a lot, right? So with an option spread, we make money on 4 out of 5 of these. So we would make money on all of this if the stock does all of this, and only lose if it does this here, right? So those are the safe bets that we want to make. Oh my God, how do I get rid of all this garbage? So what we're gonna do is we're going to, like I said, I don't chart, so I'm not really good at this stuff. What we want to do is we just want to find our price. I personally don't think it's going to get below, say, 44 right here at the bottom of this wick, this candle right here. So what I want to do is I'm going to pick this as my spot, 44-ish right there. Okay, this is my sort of line in the sand. All right. So if I just buy that, let's go over here. Yeah, let's go over here to XRT. If I just bought that option, so what we're going to do, we're going to go here, trade XRT options. And if I just sell that put, the $44 put, right? So if I just sell that, we're just going to sell one contract, and we're going to review this just to see. You'll see right here, right there, that's how much collateral I need to place that sell order. $4,200, almost $4,300 to make $24. Risking $4,300 to make $24. So obviously, yeah, we're gonna cancel that and get out of that and take that off of there. So, right, we'll get back to here. We don't think it's gonna go below 44, but we're not really willing to risk $4,300 to do that. And why it's risking that much is because when you sell, you are obligated to buy or sell those 100 shares at the strike price. So no matter what happens to the price, we are saying we will sell or buy 100 shares of XRT at $44, right? So now here's where the magic happens. Let's say we want to sell the 44, but what we're going to do is we are going to come down here about maybe 50 cents or a buck below and buy. We're going to buy a put right there. See what I'm saying? So this is why it's called a spread. All of this area between these two lines is the spread between your sell and your buy. Clear as mud? Let me show you. So we just sold the 44, and it was going to cost us $4,300, right? So let's do this. Look, in Robinhood, you can select more than one option on desktop. On the app, you'll have to go to the top, and there'll be a select button. You hit select, and you can choose more than one option at a time. And watch this; it knows what you're doing. Okay, so here we're still gonna sell this put, because remember, selling a put is the same thing as buying a call, right? We want it to go up. We're selling that put, so we don't want that put to get hit, right? So we want the price to stay up. So we are selling up here, selling the put, and this is expiring next Friday. So we're gonna click this one. It's gonna put it in our cart here, and then what we're gonna do is we're gonna select buy, and then we're gonna buy the 43.50 right there. See that? Bingo bango. It knows. Robinhood knows that is a credit spread, and that's what you want to do. It does it automatically. So what this does is it's insurance. That's all it is. You're just buying insurance for $14. That's what you're doing. Instead of being on the hook for 43, let's see. We're gonna do one. $50. $4,300 to $50. And let me just go back over here really quick, because I just glazed right over the best part of this. Look at this. This is the put that we sold. Right here. You see that? 76% chance of profit on that bet right there. 76%. And this isn't math that you have to do. This is like legit math, like the Black-Scholes algorithm that these people, this is like how everything is priced in. So here are the Greeks, right? The Greeks, this is how much the price of this option will change with every dollar it moves. It also loosely correlates with the percentage of it being out of the money. Out of the money means we make money. So you can see 28 and 76 is really, it's pretty close. So if you don't have this percentage on your broker, then you can kind of go by delta. Gamma is sort of a multiplier of delta. We've been over this. Now theta is our friend. These two are like our best friends. Theta is time decay. So as sellers, we want theta's working on our side. As buyers, theta's working against you, because every day that passes, your option is worth a little bit less and a little bit less and a little bit less because of theta. And theta tells you how much that option is going to decay. It looks like 3 cents a day or something. So theta is our friend as sellers. It's our enemy as buyers, because if the stock has to move, the underlying has to move, or theta will kill you. It's like rust. Buying options is a depreciating asset. Okay, vega is volatility. We want high volatility as sellers. I'm just gonna stop talking about stupid Greeks. Okay, let me just reiterate what we did here. So we're selling the $44 put, and we're buying the $43.50 for insurance. Now the what you're on the hook for is the spread, the difference between the strike prices, 44 and 43.50. So it's 50. You're on the hook for 50 cents, right? And the other way to know if you're getting a good price is the width of the strike times the probability of it being in the money. So the probability of it being in the money was about 25%, and we're getting the width of the strike is 50 cents, 25% of 50 cents. What is that? 12. So we're not quite getting as our money's worth here. We're not quite getting $12.50, which is about what we should get. But for the purposes of this video, we'll go ahead and buy this. So we're going to buy this. Submit. Now it doesn't fill automatically because we need someone on the other side to buy that put and then sell us our other one. But I just wanted to go over really quickly. That is credit spreads. Did anybody follow any of that? I hope you did. But if you didn't, drop me a link. Drop me a question in the comments, and I'll try my best to answer it. But that's about as simple as I can make it. We are just picking a spot where we don't think it'll get to, and then selling someone that option. Right? We're booking that person's bet that the price isn't going to get there. And for booking that bet, we get that premium. So that $10 that we saw just now that we got, that's us. That's ours. Right? We got that for selling it. Well, when the thing sells, but we get that. So what we want to happen is we want the price to stay above this line. Whatever it does, it can do whatever the crap it wants to do up in here, as long as it stays above or it finishes. Like, it can go all the way down here if it wants and stay down here, but as long as it gets back above our strike price, wow, that's just beautiful. Oh my God. Do I make you guys so proud? As long as it stays above that, or it expires above our strike price, that's when we make money. I'm rambling now, so I'm confusing everyone. Anyway, I'm gonna end the video here before I make it worse. All right, so anyway, see you guys in the next one. Peace.